All right, my name is Amar, and this is,
Kyle?
and today we're going to be talking about alternative investments and kind of how they're taxed, right? And a lot of the appeal of alternative investments is that they're not publicly traded. And before we get into this topic, we're gonna just do our disclosures real quick. Uh, Bear with me. You want to say anything here, Kyle, or
I think we can let the disclosures speak for themselves, but
right?
yeah, I think yeah,
Basically, we haven't entered a relationship, and we haven't taken your account or your specific situation into account. And yeah, and that's basically it, right, Kyle?
yeah, and Amar and I team up for these educational videos, but we
Oh yeah,
operate
everything is educational purposes. Yeah,
separately. So Amar's with Client First Capital, I'm with Clover Hill CPA, and we just provide complimentary services, not under one roof here.
yeah, yeah. It's two separate business entities. Um, So let's talk about this. So a lot of people have been looking at alternatives because the public markets have gotten kind of frothy, whatever you want to call it, and they're looking for like more consistent income, more outside the box type investments. A lot of people, the big three are real estate, hedge funds, or private equity investments. So let's talk about how those are taxed, Kyle.
Sure. So, typically when you're buying and trading publicly traded securities, the tax reporting for it is fairly straightforward, right? You have your purchase price, your sale price, and your capital gain on the difference, and that gets reported to you on a 1099 that comes from your broker. So if that's Fidelity or Schwab or Vanguard or whoever it may be, you just get that form at the end of the year. You plug it into your tax return. The reporting's pretty straightforward. Um, Now, with the alternatives, hedge funds, or real estate investments that you make through a partnership or a publicly traded partnership, um, those will produce an annual K1 that gets reported that flows directly to your tax return. And basically, the tax character of the underlying investments in these funds flow to you as well. So it's not as simple as just capital gains and losses.
Yeah, and it's interesting because at K1, man, I know there's been an evolution in the K1 uh, of these companies distributing K1s, but historically they've always been late, right?
Yeah, and so that's one of the kind of the characteristics of clients that I have that have a lot of these um, type of investments that produce a K1 is that we usually file their tax return on in September or October, just
Yeah.
because the funds have to complete their tax return, which have to rely on other funds, and it just the way it works is that those just come in last typically, especially for the alternatives and private equity type investments.
So plan on filing an extension if this is held in a taxable account, right? Like you should mentally prepare for that. I know some clients can get a little upset that there's one thing holding up their tax return from being completed.
Yeah,
And
I extend clients all the time. It doesn't create any audit red flags, and it's really pretty standard.
yeah,
So I know it's kind of something to get used to, and it sounds like you're delaying and deferring your taxes, but it's really just an extension to file,
yeah.
not an extension to pay, right?
And sometimes that maybe if you have a qualified account like an IRA or Roth IRA, maybe those are better accounts to hold these type of investments in, particularly because there isn't a tax reporting event that happens on your personal tax return. It's just when you take income out, that's coming from the custodian, so you're not going to have to wait on anybody else to finish their returns to trickle down, if you will.
Yeah, that works fine for yeah, large scale flow through investments.
Yeah.
If you have any personal kind of, if you're grouping up with 4 or 5 friends and doing a real estate investment in a partnership, then I would not do that in an IRA.
Yeah,
It's too
yeah,
much
yeah.
complexity.
Yeah, that direct investing through an IRA is very complex, and needless to say, you're going to have a lot more. administrative stuff to do as well. Like I know with one of our clients, they have to get an annual appraisal of their investment, and then they have to get cash flow available for RMDs and stuff like that. So it's just a big headache.
Yeah.
Anything else you want to talk about, Kyle?
Yeah, I think just the type of income that flows through does depend on the type of investment. And so, if you're doing a hedge fund, for example, most of that income that flows through is going to be portfolio income, so interest, dividends, and capital gains. If you're doing a real estate type investment, the big benefit you get there is that the depreciation that the fund would take on the underlying real estate flows to you, and so you get usually a pretty low annual tax burden on real estate partnerships. And then private equity is more of when you're buying and selling, the capital gains are going to flow to you. It's not a ton in other income. So it's always just it's important to be cognizant of what type of income is going to flow to you from these investments, because the tax treatment can vary quite a bit.
Yeah. And I guess I would end on this as well, saying is you have to do your due diligence. A lot of these private placements and investments that you'll be looking into, just reading the first couple pages is not enough. You have to really dig deep in. There's embedded fees. There's other structured parts. A lot of times, these products are very time sensitive, right? Because there's a lack of liquidity. When you purchase these investments may mean more. For example, in 2004 to 2007, commercial real estate, went really high and then it collapsed essentially. And so if you bought into a private investment that was real estate focused in 2004, 5, 6, 7, oh, you got hurt. You got hurt really bad. But if there was a new fund that was starting in 08 or 09 and you put money in there, I mean, you made a lot of money, and that's simply because of the timing of it. So when you look at your taxes, one component of the taxes will be the timing of your investment. Remember, there's a period of time where the fund is open and they're collecting new dollars, they're doing capital calls. And then there's a period of time where they're maintaining the underlying investments that they've made, and then they're making a final distribution, over a period of time. So those are some key things. If you have questions or concerns, I know we're heading into the holidays, so happy holidays, everybody out there. And hopefully starting the new year, we'll be doing these more consistently. And if you have questions or concerns or topics or ideas that we can talk about, please leave it in the comments. Anything else to add, Kyle, before we wrap it up?
No, well said, Amar, and appreciate the time, and thanks again.
Sounds good.